Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool and value investors' best friend. I'm also known as Mr. Valuation because value investing is what I'm all about. In this series of videos I've been doing on the 11 sectors, the GICS sectors produced by Standard & Poor's, is basically looking for value in essentially an overheated market. All right, that's really what I'm all about. But I'm using some simple screens here. I do want to say something because I've got some questions on the screens. There's a lot of different ways you could screen and different things you could screen for. So I've done some very simple screens here, and I've kept them consistent throughout all of these sector videos. So we're going to go ahead and get into that. Before I do, let's turn to FastGraphs and just look at the market, because the point is the market is trading at a very high valuation relative to historical norms and relative to fair value, to be honest. So let's go ahead and start by going into FastGraphs and looking at the market. To do that, I start here with the FastGraphs dashboard, which gives me some information, but one of the things it really gives me is a quick glance at the market. This is the SPY, which is the Standard & Poor's 500 ETF. And as you can see, the orange line on this graph is a 15 PE. The blue line is 19. So 15 to 20 is actually the number that I put my head on. 19 is a little bit under 20, but it's rational. And that's, you can see that this black line, the weekly stock prices, typically trade within or close to that range of 15 to 20 times earnings. And of course, now it's trading at a trailing PE of almost 25, 24 and a half. All right, and that's very expensive for the S&P. Now, I can also look at the Russell 3000 ETF, and I get exactly the same scenario. I've got here now orange line, fair value PE of 15, and the normal PE of 19.8, which is actually closer to 20. And once again, you see that that's the market trades at a 20 PE consistently, but the real low risk, most opportune times to invest in any of these indexes is when it's down here at a 14 or 15 PE. And once again, we've got a trailing PE of 24.66 on the Russell 3000. So both of those markets are extremely high. So what I've done is, it is a market of stocks, not a stock market. Within these 3,000 or within these 500, there are going to be overvalued, fairly valued, and undervalued stocks to be found. So the purpose of the screen is to find those that are fairly valued. So I've just done a very simple screen here. And by the way, when you're running a screen like this, you're going to get garbage in, garbage out, and I'll explain that more later. So I've got 6 things under the general categorization here. I looked for stocks in the material sector. Okay, that's what I screened for. I screened for primary, and by the way, some people tried to duplicate my screen and can't. You have a drop down here. You have to put true, that it's true that it's a primary if you want to duplicate my screen, but you don't have to, by the way. And then I just checked dividend yield. I didn't put any information here. I just want stocks, I want to see if they pay a dividend. I want to be able to see what the result is on my screen. And I want to see the PE ratios of the one I screened out. And I want to see the earnings yield. But here I did add an earnings yield of 6% as a minimum. Now, 6.5 to 7 is what I prefer, but this gives me a shot at getting a pretty decent screen, as you can see. All right, and then under historical, under the historical tab, I just looked for 5-year earnings growth that was positive. Very simple screen, as I pointed out. And for the estimated tabs, I wanted total returns that are greater than 5%. So I wanted positive expectation of total returns. I prefer higher than this, and I will call out, see what I've screened and get that. And I'll show you what I mean by that in a moment. And I wanted positive EPS growth. Okay, and then regions, I just picked US and Canada. All right, so those were my screens. All right, when I ran the query here, what I got was 21 companies. All right, now I already did this, and I think I only had 19 because the screen changes as you run different time. Because time changes, the data is going to change. But anyway, I would run the query and I would get this list of stocks. So I created a portfolio, and like I say, I only had 19. So 2 more have shown up since I originally did this and set this video up. But it's not really that relevant. The point is, this just gives you a list of research candidates that you can evaluate from here. All right. And what I did was in the screen, I did this add to portfolio feature and I clicked that and that gave me the portfolio that I have here. So this is a portfolio. And then I created views. You can always create more views, but I created a materials one view where I just looked for long-term debt, dividend yield, PE, and earnings yield. Very simple at this point. All right, but I had these 19 companies. Now, the acid test is always to go through each of the individual companies. And you would do that from a portfolio just by clicking on the name of the company, and that would give you a look at the stock. And then you can decide whether or not it's one that you want to keep in the portfolio. But just to be clear about that, let's say you found something that you didn't want in the portfolio, all right, that you didn't like. So I don't particularly like this company because as you can see here by the earnings, you had these explosive earnings and a collapse in earnings and high earnings and a long period of time. Bad earnings, you had all types of dividend cuts. That's the white line on the graph. This isn't the kind of company that I'm really interested in. So what you do is, as I'm doing that, I would click the ICL and then I would delete that ticker, okay, with fast graphs. So now I don't have that stock in there anymore. Once it clears, all right, it's gone. Now I'm down to 18 stocks. So you can go through this portfolio. Now I also did that already. And what I created was a second portfolio that I named Materials 2. All right, and I just have the holdings here. So again, I'm going to just show everyone this because I did have people that in my last video that were happy to see this because they didn't know this existed. I'm going to create a new view. I'm going to go for credit rating. I know I'm in the material sector, so I'll ignore that and I'll do sub-industry because it's something I want to look at in the view. I'm going to look at long-term debt to capital. I'm going to, because I like to see what the balance sheet, just a snapshot of what the balance sheet looks like. I'm going to put in the dividend yield because if I'm investing for income, I want to see what the dividend yield is. If I'm investing for growth, it doesn't matter. And I can pick candidates of both. I'm going to put the PE and the earnings yield just listed here. And I've created now my view. Now I'm going to go into, that's what I did on my general selection, but I want to go into estimated, okay? And I want to see what the total annualized rate of return is expected to be based on analyst expectations. And then I'm also going to look at the earnings growth. I want to see the trend line earnings growth. Now you could pick any of these things you want, and I want to make it clear, these are just the things that I personally like to see. And it's asked me to name it, so I got to name this Materials 2, just like the same name of the portfolio. I'm going to hit Create now. And now I've created this view with those items that we clicked. Now, I normally bring earnings yield over because I want to focus on it. And if I was looking for dividends, I might want to look at dividends. The sub-industry sector is not as important, and the credit rating is important, but it factors that I want to evaluate because these are stocks that I'm looking at for due diligence. Now, I went through that calling process that I talked about earlier, and out of the 19 original stocks, I just kept 11 that I would be interested in learning more about. And I might even put this down more. So let's look at those 11 very quickly here. If we look at Ashland Inc., it's got decent growth, but it was very choppy back here. They paid a special dividend. Fast Graphs gives you a lot of historical perspective, but I'm going to shorten the time frame here and look at the last 15 years, which, by the way, is not 15 years because it includes 2.25 years of forecasting because this company has a September forecast year, but earnings growth was 4%. But we had 2 very weak years here. I'm analyzing the stocks and looking, I say, what happens if I take those weak years out? So I would take 2 more years off of the total here, and all of a sudden my growth runs up to 6%. All right, and I can see the relationship between earnings and market price. I can see that the market has put a high multiple on this stock. It has relatively low debt, but it's not an investment grade company, but it's a specialty chemical company. So now when I go into forecasting, the analysts, and there's 8 of them, it's not widely followed, think the stock is going to grow at 13.18%. By the way, I've created FastGraph to be convenient. I can go into Yahoo estimates, okay, and then I can go into analysis on Yahoo. And this gives me earnings estimates that I can check against what I'm seeing from FactSet. These guys get their data from Reuters. FastGraphs is currently getting it from FactSet. But based on this, at a 15 multiple, this would give me a 12% potential rate of return. This would be a nice conservative number, and it's a little bit above the ideal 15 times earnings. It's trading at 16 times earnings, but the 13% expected growth compensates for that. If I go to the normal multiple, which has been over 20 times earnings, and evaluate what my potential might be based on that number, I get a really outstanding 25% potential annualized rate of return if all these things come to pass. And I've got an analyst scorecard that is abysmal, okay? So the question is, do I put much credence into that? Now, I would like to know why the analysts think that, so I might do some research here, and I go through the process of doing that in a future video. I've been asked to pick a stock, and I'll do that with one that I'll pick here in the future. But for a high-level video like this one, the question is, do you believe these analysts? Well, there's a lot of misses here, and misses have been consistent year after year, and some of them have been pretty big. So that makes some sense to me when I look at the cyclical nature of the company and see how erratic earnings can be. It's very difficult for analysts to forecast that. But anyway, that's Ashland. And I might delete that one, by the way, for the reasons I've said. The next one is Cabot Corp. It's another commodity chemicals company. Again, there's a lot of cyclicality in a lot of these material stocks. But here's a case where if I look at, say, the last 6 years of this graph, growth has been pretty strong. Let's do it 7 years. 7 years, it's been real strong. But I want to caution you when you're using the tool, this is an analytical tool. It's not designed to dictate stuff to you. It's designed to help you figure stuff out. Okay, here we've got 141% growth from in through September 2021. So if I shorten that again, that was following a 47% loss through COVID, or negative growth, not loss, but negative growth. And then that was followed up with a very strong growth. So that's kind of coming back to a more normal potential earnings result that the company has been achieving in the past $4 or $5 a share. That's something, again, I would take into consideration. But I always look at these different time frames. The shorter time frames are always the most relevant, and ultimately the forecasting is the most relevant. So now we have another stock. It's BBB rated, by the way, so this one is investment grade. It has 44% debt to capital, which I kind of like. I like anything under 50%. It's a small cap, $5.17 billion. Maybe some might call it a mid cap. And the market, the normal multiple the market applies, has been a discounted market. So even at a 12.6 multiple, which is what this blue line is, you can see that in the orange box up there at the top here, this would give me almost a 10% annualized rate of return. At a 15 multiple, which I think the stock should trade at, I'd get a 16% annualized rate of return. Now, when I look at the analyst scorecard here, it's a lot better than what we saw a minute ago, but it's still not great. They missed 42% of the time on 1 year and only a third of the time on a 2 year, but there's margins of error that have to be factored in. So I keep going through. And here's Crown Holdings. This used to be the old Crown Cork and Seal. This was an interesting stock. Years and years ago, lost a lot of money on this stock for a very bizarre reason. The company had made an acquisition, and in that acquisition, there was a division of the company they bought that was an asbestos seller or manufacturer. They sold that within 90 days of making the acquisition, but yet they were the last man standing in the asbestos debacle, and they got crushed. Now, since then, they've been recovering nicely. But once again, I want you to notice something here. I've got a 17% growth rate when I use the max view. But if you look down here, I've got two very aberrant numbers here, actually three. All right, so if I shorten that, let's say to a 19-year graph, now all of a sudden I'm getting about a 9.48% growth rate. I shorten it to 11, I got 6.9. I shorten it to 8, I got 4.7. So what's happening is I'm measuring different levels of data here as I'm doing that, and what I'm seeing is the growth rate has actually been slowing down. In fact, most recently it's been negative, but that's only too small a universe in that case. But if I go to forecasting, analysts think it's going to grow at 8.82. That's reasonable considering the fact of the cyclical nature, again, of a lot of these material companies. But this has been a pretty consistent performer over the years. All right, now they were coming off a couple of bad years. So I go back to forecasting, I check the analyst scorecard. The 2-year forecast has been pretty darn good. They've only missed 8% of the time, but that's with a 20% margin of error. So I've got a little more credence in the 2-year forecast than maybe I do the 1. But again, that's just a starting point. If you're going to do research on these stocks, you need to go in and do more comprehensive research than just looking at the fast graph. But the fast graph certainly cuts out the time that it would take. It keeps you from wasting time looking at companies like the one I called out of the portfolio here that aren't any good. Now here's Graphic Packaging. Once again, we see a real strong growth rate when I look at a long-term view. But I want you to notice the company lost money from 2004 to 2008. Then in 2009, it made a little bit of money. Then it had this huge growth. So again, I want to cut this down into something that where I'm getting some reasonable numbers as far as how the company performs. I've got a 17.5% growth rate. The market expects it to grow at 7% going forward at a 15 PE, which means it would expand from a 10.87 it currently trades at. That would give me a double-digit rate of return. I've got a pretty decent scorecard, again, for the material sector in this case. The normal multiple in this stock has been about 14, just under 14 times earnings. That would still give me over a 20% rate of return. And again, if I just judge it based on history, it's not uncommon for this stock to trade above a 15 or 16 multiple. All right, so this might be one I might want to look at closer. Offers a 1.5% dividend yield, does have a lot of debt, no credit rating. And again, it's a smaller size company. You might call this a mid cap at $8 billion in market cap, $13 billion in total enterprise value. All right, but again, you have to decide whether this is the one you want to spend time researching or not. Then I come into the next one here, which is a very low yielding stock, almost no dividend. Materials Technology, another specialty chemicals company, a modest dividend, but they have consistently paid a dividend, but this offers no yield. This is purely about growth. In terms of forecasting, analysts expect 13% growth. At a 15 multiple, that would give you double digit. At a normal multiple of 13.5, that still gives you double digit, 18.5, almost 19% annualized rate of return. And again, an analyst scorecard that is decent for the material sector. But again, you'd want to go further and you want to look deeper into companies like this. Again, you can learn from the history. You're very likely to face some periods where earnings growth isn't so hot. It is expected to be pretty strong for this year and the next 3 years. And this one does have a December fiscal year. But again, how much you can depend on that has to do with how you evaluate the analyst scorecard. All right, the next stock on the list would be PPG Industries. This probably is my favorite. I like it because it has a nice dividend yield. It's one of the more steady growers. The market has put a premium valuation. It's a triple B plus, almost an A-rated company, so it's investment grade, has manageable debt at 44.72%. Looking at it going forward from what the expectations are, they expect 8% growth. This would give me a double-digit rate of return with a 2.5% dividend yield. And I do want you to note that the dividend has consistently grown year after year after year. So if you buy this at value, it's now trading at under a 15 PE. So if you bought it at a very similar PE, say back in July of 05, and held it today, even after this overvaluation had changed, and held it to today, you'd make 8.23%, which is very consistent with the growth rate over that time frame, okay, the total return. All right, so PPG would be a solid holding, not necessarily one that's going to make you change your life, but it's a solid long-term investment, especially if you're looking for income. Sealed Air is another one, high debt, only double plus rated, but this one does look pretty heavily undervalued here. At a 15 PE, if it produced the earnings growth of only less than 5%, you could still make 23%. And then if you looked at the normal multiple, which has been, again, under 15, you'd still make 18%. But let me explain to people how this works. We've got an 11 PE, okay? Historically, for the last 5 years, the stock has traded at a 13.6 PE. So what we're saying is if we get 5% growth, that's 5%. If we get 2.3 dividend yield, that's expected to grow ever so slight, or in this case, they expected to be flat. That would be 2.3 more. So now we're at like 7.5 or so. And then we get a PE that increases from 11 to 15, or in this case, 13.65. Then that gives us our 18% rate of return. So it's growth plus income plus PE expansion. And it works just the same when you're looking at stocks that are contracting. Again, we have a sketchy analyst scorecard, materials that tend to be cyclical. Okay, the next stock is Stella Jones. We're not expecting a lot of growth. I'll do this one backwards. The normal PE has been about 14. The fair value PE has been 15. So if I look at this stock historically, we see that the market has traded it around a 15 multiple. Now, this 19.5% growth rate is once again aberrantly inflated by these really strong years beginning. So drop this to a much shorter time frame, and what we're going to find as soon as there we go, it's a 12% grower rather than the high number that we saw initially. Forecasting-wise, Stella Jones expected to grow only at 3.1%, but it still pretends to give you a decent rate of return if this was the type of company that you were interested in investing in. Okay, moving on, we've got Silgan Holdings here, moderate debt, 8.5% growth, a 15-year time frame, 12.7% on the max. Looking at a shorter time frame, I'll do 9 years here, it's 11.75. Forecasting is 11.5. So the analysts think that this company has some growth ahead of it. It's got a pretty decent scorecard relative to most materials, so this is one you might want to take a closer look at. It does offer some return potential and it's trading in value, but note that for the last 5 or 6 years, it's been more relevant to the blue line, which it's still slightly ahead of or slightly above. You'd want to take that into consideration. The next one on the list is Sonoco, and Sonoco is about a 7% grower. They had this surge in growth. This is a paper and plastic packaging products and materials. It does offer a very healthy 4% dividend yield, a decent record of growing the dividend over time. So if you're an income investor, this is one that might, in the material sector, it's expected to grow at 7% plus for the next several years at a 15 multiple, which is normal for this company. This would give you an extremely strong return. Again, a normal 15 multiple, an extremely strong, over 36% annualized rate of return. This is probably my favorite in the group. It's BBB minus, does have some debt, but it's a very high quality company. Remember, you can always go into external links and go into the corporate website and learn more about what the companies that you're looking at do and spend some time in there. Okay. The next stock, and I think the last one on the list, is Winpak Ltd. I chose this one for a couple of reasons. They do have a record of paying a special dividend, but they're really not a dividend-paying stock, okay? We see that very vividly on Fast Graphs. It's got a pretty good growth record. Again, I shorten the time frame. It's almost a double-digit grower. The analysts are expecting 8.22% growth at a 15 PE. That would give you a 12% rate of return. At a normal PE of over 18, that would give you a very substantial 24% rate of return. It has one of the best analyst scorecards of any of the companies we've looked at in this group. So this is one that you might want to consider. And again, look at the lessons in valuation. When the market was valuing this at high valuations, very similar to how they're valuing the stock market in general now, this stock ends up being a 5 or 6 year loser. Okay, but on the other hand, if you buy it in value or undervalued, it ends up being, same company, a double-digit returner. So valuation matters, and it matters a lot. Anyway, these are the companies I look at. As I mentioned, my favorite stock in the sector here would be PPG. If I was going to look myself, because I'm looking for income and I'm looking for growth of income, but that's, you have to invest according to your own goals, your own needs, your own risk tolerances, and your own view of what you look at. What Fast Graphs does is crystallize this information for you so that you can make the proper decisions going forward. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. Hope you enjoyed this video on the material sector. This sector has its place if you especially are looking to really get diversified across all the sectors, But the nature of the beast here, you got a lot of cyclical stocks, and you've got some that really, I think, are just really poor investments. But again, that's up for you to decide. My job here is to present research candidates that might intrigue your fantasy to where you might want to look deeper or not. Anyway, if you like the video, ring the bell and subscribe to the channel. By ringing the bell, you get notifications of future videos. Also, take a look at subscribing to Fast Graphs. It is the value investor's best friend, and it's a great tool to help you easily analyze stocks before you waste a lot of time going through the rigorous due diligence process that ought to be done for all stocks. Thanks for watching, and Merry Christmas and a Happy New Year to everybody. I'll probably do one more video before the year's out. But anyway, thanks for watching, and talk to you real soon.